Welcome to InvestorHubX.com. Market tops rarely arrive with a warning. There is no announcement, no signal telling retail traders the rally is over. Instead, price begins to stall. Volume behaves strangely. False breakouts flicker across the chart. The crowd remains hopeful, and that hope is precisely what allows institutional sellers to exit quietly. This slow, deliberate process is what Richard Wyckoff identified over a century ago. He called it Wyckoff Distribution. In this video, we will talk about what is Wyckoff Distribution, the psychology behind Wyckoff Distribution, the important characteristics of Wyckoff Distribution, how traders use Wyckoff Distribution to identify potential market tops and weakness. If you enjoy this video, don't forget to like the video and subscribe to our channel. It helps support our channel and allows us to continue producing more high-quality educational videos. Let's begin. Richard Wyckoff was one of the pioneers of technical analysis in the early 1900s. After years of studying market behavior, he noticed that large institutional operators tended to leave footprints on the chart. He observed that market tops and bottoms were not random. Instead, they unfolded through repeating cycles of accumulation and distribution, where smart money quietly bought from fearful traders at market bottoms and slowly sold to optimistic traders near market tops. More than a century later, traders still study Wyckoff's ideas because human psychology, fear, and greed has never changed. Wyckoff's framework breaks the distribution process into 5 distinct phases, labeled A through E. Each phase reflects a specific shift in the balance of supply and demand, and each leaves observable clues on the price chart. Phase A marks the first signs that the uptrend is weakening. After a strong rally, price begins to face heavier selling pressure. A final surge higher, known as the buying climax, BC, often occurs on high volume as retail excitement peaks. Price then falls sharply in an automatic reaction, AR, followed by a secondary test, ST, that fails to make strong new highs. This inability to sustain higher prices is an early warning sign that institutional selling may have begun. The range between the BC high and AR low forms the beginning of the distribution zone. Phase B is the longest stage of Wyckoff distribution, where price moves sideways within a trading range. During this period, institutions quietly sell their positions over time while the market appears stable. Price repeatedly tests support and resistance, creating the illusion of consolidation. A key warning sign is weakening volume on rallies and stronger volume on declines, suggesting smart money is selling into market strength. Phase C is the deceptive stage of Wyckoff distribution, where price briefly breaks above resistance, creating a false bullish breakout before reversing back into the range. This move traps breakout traders and adds selling pressure to the market. The key warning sign is price failing to hold above resistance, often with increased volume, showing that selling pressure has overwhelmed buyers. Phase D confirms that sellers have taken control of the market. Price breaks below support in a strong move known as the sign of weakness, SOW. Any rallies that follow are weak and form lower highs called last point of supply, LPSY. These rallies often become the final exit opportunities before a larger decline. Increasing volume on sell-offs and weaker volume on rallies confirm growing selling pressure. Phase E marks the start of the downtrend after distribution is complete. Price breaks firmly below support and begins a sustained decline. Traders who mistook the range for consolidation are now trapped in losing positions, adding panic selling to the market. By this stage, smart money has already exited, leaving the market vulnerable to a sharp markdown. So, what is the psychology behind Wyckoff Distribution? Wyckoff Distribution is driven by the difference between smart money and retail psychology. Institutions cannot sell large positions all at once without crashing the market, so they distribute slowly within a trading range while retail traders continue buying. Retail traders are often driven by FOMO, news hype, and bullish sentiment near market tops. What appears to be healthy consolidation is actually a gradual transfer of assets from strong hands to weaker hands. Institutions may even push price to new highs through upthrusts to attract more buyers and create liquidity for their exits. By studying price and volume carefully, traders can spot these footprints left by large operators. Wyckoff Distribution leaves clear warning signs on the chart for traders who know what to look for. After a strong uptrend, price begins moving sideways within a trading range as institutions quietly sell into retail buying. A major warning sign is the false breakout, or upthrust, where price briefly breaks above resistance before quickly reversing back into the range, trapping breakout traders. Volume behavior also changes. Rallies become weaker with lower volume, while declines attract heavier volume, showing growing selling pressure. Momentum gradually weakens, with rallies becoming smaller and slower despite price revisiting the highs. Repeated failures to break above resistance confirm that supply is overwhelming demand, signaling that smart money is distributing positions before a larger decline. Wyckoff traders wait for confirmation before entering a short trade. Instead of guessing, they look for a strong breakdown below support with increased volume, confirming the start of the markdown phase. After the breakdown, price often retests the former support level, now acting as resistance in a move called the last point of supply. This retest can provide a higher probability entry with a tighter stop loss, especially if the rally occurs on weak volume. Volume is used throughout the process to confirm price action. Strong volume on breakdowns and weak volume on rallies strengthen the bearish case. Most importantly, risk management is essential. Traders should define stop-loss levels before entering and avoid risking more capital than they can afford to lose. If you find this helpful, please visit InvestorHubX.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. To summarize, in this video, we explore the complete Wyckoff distribution process and how smart money quietly exits the market before major declines begin. You learn the 5 phases of distribution, including the buying climax, building the cause, upthrust, sign of weakness, and markdown phase. We also discuss the psychology behind distribution. The video explains how Wyckoff distribution leaves key footprints left on the chart. Finally, we turn analysis into a practical trading plan for Wyckoff distribution understanding. Wyckoff distribution can help traders recognize potential market tops, avoid bull traps, and better understand how price and volume reveal the actions of smart money. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.